So, Sarah, tell me a little bit about our guest who also is named Sarah.
Well, obviously she's amazing because her name is Sarah. But no, Sarah Borders, I was introduced through another one of our podcast guests, Shandon Fowler, and she is just a compliance expert, and she works with employers, and she says that she can eliminate on average $300,000 in fines. She knows the compliance of ICHRA inside and out, and she is able to explain it in a way that we can understand it, which is huge. So she's going to join us. She's going to talk us through what she's learned, what some of the pitfalls are that employers and brokers can learn to avoid, and help us be successful with ICHRA.
That's awesome. I know, just coming, from the world of ACA a decade ago, we're now here again in this whole new world of compliance and new regulations and new fines and penalties associated with the plan designs and what you can offer your employees. And so, yeah, I think employers are really going to want to listen to what Sarah has to say and how to avoid those penalties.
Absolutely. Let's get to it.
All right.
Tell me, how did you get into compliance?
Well, back in 2014, I was an account manager for a local benefits broker in Austin, Texas. And the ACA had passed years before that, but that was the year that everything started to really come down on employers. And so they asked me to become the kind of resident compliance expert. And I said, I would love to. And that's kind of how it started. So I went from there to a national large employee benefits firm and just focused on compliance since about 2015. So here I am today, still doing
Nice.
this.
So let me ask you this. Were you a rule follower when you were little?
I suppose I was. I didn't know it at the time, but I do like rules. I do like kind of black and white to-dos and so forth.
That was my thought too, Sarah. I'm like, wow, somebody who volunteers to do compliance, usually that's sort of brought upon you, and you now own something plus compliance.
Yeah, I have to say you're my people. I like rules. I like when they're clear. I like the black and white. This is what you do. This is what you don't do. So I can appreciate your interest in compliance. Well, thank you so much for joining us today. With your expertise in compliance, you've actually been a huge help to WELL in kind of navigating the compliance complexities of ICHRA. And I'm so glad you've joined us today to talk a little bit about that. I think you were going to talk to us about 3 kind of high-level compliance areas, the difference between the minimum essential coverage and the affordability requirements, what a compliance notice is in the world of ICHRA, and a little bit about the class size requirements. So why don't we start with the Mech and the affordability requirements? Can you talk to us a little bit about that?
Absolutely. So I think it's important to understand why we're talking about Mech and affordability in the first place. And the reason that an employer or a broker working with employers would even want to be looking at Mech and affordability goes back to who has to comply with the employer mandate. And those are those penalties that could apply for failure to offer minimum essential coverage, which is Mech, or offer coverage that provides minimum value and is affordable. And so applicable large employers, those generally speaking with 50 or more full-time employees plus equivalents, have to comply with this employer mandate, or they could be assessed a penalty. And many of them have seen those penalties since probably about 3 years ago. Those letters have been going around. So if they want to avoid paying a penalty, they can, instead of maybe offering no coverage or a skinny Mech plan, you may have heard of those, they can offer an ICHRA instead. And an ICHRA would simply be a vehicle that allows them to reimburse coverage that they can purchase on the exchange in the individual market. And this is the only way an employer can do that. So an applicable large employer would be able to avoid those penalties by offering an ICHRA, which is considered minimum essential coverage, Mech coverage, which gets them out of penalty A. And that's kind of what we would call the sledgehammer penalty, because it applies to all employees minus the first 30 for each person or for each employee that they employ. And that could be triggered by simply one person going to the exchange and receiving a premium tax credit. So that would be applied anytime an employer doesn't offer at least 95% of their full-time eligible employees Mech coverage. So that's penalty A. Then we have penalty B, which is a different type of penalty, and it usually goes that if they don't owe penalty A, they may owe penalty B. So they kind of look to the next level of things. Penalty A would apply anytime somebody goes to the exchange and receives a premium tax credit. Again, that's what triggers these penalties in the first place. And the employer is found not to offer minimum value coverage that is affordable. Minimum value coverage is not the same thing as Mech. It is simply an actuarial determination about how much a plan pays with cost sharing, essentially. And so an ICHRA is considered minimum value coverage, which is good. Also Mech coverage, but it has to be affordable. And the affordability determination is really incumbent upon how much the employer actually gives them for reimbursement for their premiums. So that's really the piece where employers are going to have to pay most attention to, because they want their coverage to be affordable. And that's kind of where some math comes in.
Yeah.
Can I ask a quick question, Sarah? Sorry.
Yeah.
Who triggers, or how does it get triggered? I mean, is it simply in the filling out of the information and the government or state catches that, or how exactly does that kind of like show up?
Get triggered? Yes. So it is triggered from an employee, employer's employee going to the exchange and applying for and getting a premium tax credit, which is fairly easy for them to do because they simply just have to say, is your employer's coverage affordable? Not really knowing that that's a really specific calculation. And so they may receive a premium tax credit for a couple of months, and then it doesn't really come up again until the IRS cross-references it with the employer reporting has to be done, the 1095Cs. So it could be years later that premium tax credit has already been applied, and then we're getting letters for 2017 tax year based on what the premium tax credit that was received by the person and the employer's reporting that they had to file with the IRS for that year. So it can take a long time for it to kind of sift through, but that's how they're triggered, is a premium tax credit or PTC on the exchange.
And so what I'm seeing, and based on some of the conversations we've had, Sarah, it's, if you're offering an ICHRA, so long as you're offering it to 100% of your full-time employees, you're not getting the Mech fines. You're not getting that sledgehammer. It then becomes a matter of, is it actually affordable for each individual? And if it's not, did that individual go and shop for a plan and accept a PTC? And so what we've been doing at BeW3LL is we do that calculation and we show the employer what the maximum penalty or fine may be, because in some instances, people are just eligible for a large subsidy, and based on age, based on income, based on location, the employer may not be able to afford the affordable benefit. And so one of the pieces of calculation we do on behalf of the employers with our product is to look and say, okay, well, here's who's not affordable, and this is what that maximum penalty would be, and give them the opportunity to say, okay, I kind of accept that risk that this person may go to the exchange. But then we've also seen Medicare, people who are Medicare eligible. Can you talk a little bit how that works? Because if you're Medicare eligible, you're not going to get APTC, but your affordability is still based on the silver plan, if I'm not mistaken.
Yes, and this is where it gets a little complicated and gets over into the Medicare rules. But generally speaking, they would not be they wouldn't be eligible in the first place for a premium tax credit, as you mentioned, because they are kind of kicked out of eligibility for a premium tax credit when they become enrolled in free Part A coverage under Medicare. And so really, because that is what triggers the penalty, there's not an instance where usually a 65 or older employee would even be receiving a premium tax credit to then trigger the penalty. So and you have to also look at the fact that an ICHRA cannot be 3 times, it can't be more than 3 times the amount of the lowest, youngest person. So really it couldn't be higher anyway. So really a 65 or older Medicare individual, you could reimburse for their Medicare premiums as long as you're reimbursing for everybody's in that same class, and really not have to worry about somebody that old triggering a premium tax credit and therefore a penalty.
So that's really interesting. And that's another thing that we do is we kind of highlight when your age multiplier has put you above the 3-to-1 ratio. And I was doing an affordability calculation with someone the other day, and I was seeing what I could do to get the Medicare team, or the Medicare members, I should say, to be affordable. And this was before Sarah set me straight. But so I was doing it, but in order to keep my 3-to-1 ratio valid and make my Medicare members affordable, I was giving these huge benefits to the younger people. And I was like, there's something that doesn't make sense here, which kind of initiated that conversation. But it's really cool because now we have the ability to highlight, okay, so you're over 50, that means that you do have to worry about the affordability penalty. However, the affordability penalty is actually less than what it would cost to make your members whole, or you can't do it without being crazy with some of your other groups of people because of that 3-to-1 ratio. So
well, Sarah, you bring up a great point, and I was thinking about that too. I'm like, okay, so maybe taking the penalty is financially the better option here.
And not just for you, but also for your employee.
For the employee.
I think people sometimes think not affordable penalty, that I'm being bad. And going back to what we were talking about earlier, Sarah, rule following, you don't want to be assessed a penalty. But I think in this instance, not the Mech penalty, that's bad and that's expensive and you don't want that. But the affordability penalty, there are instances where it makes financial sense for the employer and it allows the employee to get a better benefit in the APTC, or in some instances, like we have these Medicare recipients who wouldn't be getting APTC anyway.
Exactly.
So then, Sarah, you were talking about the classes, which is another compliance area that I think people are very confused about. And one thing you talked about was reimbursing Medicare expenses for people in the same class. Do you have to put Medicare recipients in their own class, or you just give them the same dollar amount and they can utilize it for Medicare if they're Medicare, or individual if they're individual?
Yeah, this is a great question, because I think a lot of employers may want to do that. Can we make a Medicare class? And the answer to that is an emphatic no. You cannot make a Medicare class, because that runs afoul of these rules called the Medicare secondary payer rules. And so we want to avoid that. We don't want to just offer an Icra to Medicare individuals to take them off the plan. In other words, that's usually why that comes up.
Right.
So instead, you have to follow, as you mentioned, the 11 allowable classes, and those Medicare individuals would have to somehow fit into one of those classes. They may just happen to be Medicare eligible. So we couldn't differentiate it based on age or something like that. That would be running afoul of these other rules that are there.
Yeah, that makes a lot of sense. And another thing that we do is when we look at the expected penalties, we say this is the total bucket of penalties that you could be assessed, but let's take out the Medicare, because we can't really see how they're going to report that, because they would never be getting APTC. So here's what your expected penalties is. And we want to give the broker or the employer as much visibility. But again, it was a bit of a light bulb moment for me and for the brokers that I was working with and their employers. Like, okay, these people are not going to get APTC, so let's not focus on them. Let's focus on the other. I mean, I think it was 93% we could get affordable, and the rest were this Medicare group. And so it was good to be able to look at that and see it. But tell me about some of the rules behind the classifications of these 11 classes, and are there minimum class sizes? How does that work?
Yeah, so within these classes, there are 11 classes, and some of them require a minimum class size requirement. In other words, you have to at least have offered the ICRA to this group of this group of classification, in other words. And so it depends on how many total employees the employer has to tell you how many people have to actually be in that class. So for example, classes based on full-time, part-time, salaried, non-salaried, or hourly, primary site of employment being the same rating area, those would all require a minimum class size requirement to be met. So in other words, I can't just have 2 part-timers If my company has under 100 lives, they have to have at least 10 in each class. So that can be a challenge for employers looking to class out certain types of employees because they just don't have enough employees in that to make up a class. And so there's other ways that it could be done, and you can make combinations of classes, but that also brings in these minimum class size requirements just based on how many employees, again, the employer actually employs.
Now, do the minimum class sizes come into play if you are offering traditional group insurance or regardless?
Only when you're offering ICHRA. So there are no minimum class size requirements, at least in the compliance world. There may be some carrier requirements for underwriting, but generally speaking, no, there's no class size requirements for just regular group health plan coverage, only for ICHRA.
So then you said some classes can be combined. So how would that work?
So they can combine perhaps employees that work in a certain state that are hourly. That could be a class that you could combine. You could do full-time employees again in a specific state or county or something like that, a division. And that division couldn't be the class itself, but that division may be located in a state and your other companies are located in a different state. So that could be a way that you differentiate that class and come up with a combination, not just having to pull all hourly employees, but maybe just hourly employees in that location.
Right.
What happens is there a certain company size where because of those minimum class sizes, it just doesn't make sense? Or they can only have one class, so they get all 10 employees in it?
I think that it does make sense. Sometimes they just can't. What I see most often is they just can't make enough. They can't make a big enough of a class. And so therefore this just isn't going to work for them. They've kind of tried to figure it out and, can we do this or that? And they just can't come up with a class that's large enough. So I think really small employers would struggle with this. They just wouldn't be able to do it at all. So probably a little bit larger employers, those who are applicable large employers may really, really benefit from this because again, they're getting out of the ACA penalties and offering a benefit to their plans, or their employees, but they also can come up with a large enough class size.
Do you feel that some of those rules might be adjusted given the barriers for very small employers?
No, they are pretty cut and dry in the regulations. The rules specifically are, and I can tell you that the rules, if fewer than 100 employees, they must have 10 employees to be offered the ICHRA in that classification. And for employers with 100 to 200 total employees, then the amount of employees that must be offered in ICHRA is 10% of the total number of employees. And then for more than 200 or more, then they must have 20 in each classification. So the larger they become, the more employees have to be in the class size offered the ICHRA. They don't have to take the ICHRA, but they have to be offered the ICHRA.
Perfect.
Another challenge that happens that we see quite often is participation requirements and sort of carve-outs are not typically allowed by fully insured carriers. And so you may have a situation where an employer wants to not offer the group health plan at all to a specific class. They can get there with the class size. They found a class that meets the criteria, but the carrier, the insurance company, won't allow them to be sort of carved out of eligibility because they have participation requirements. So that can be a challenge too, and a conversation that you must have with your fully insured carriers and even your self-funded stop loss carriers as well, because they just can't, it's not an either or. They have to be only offered the ICHRA, not the group health plan.
Right. Yeah. And I guess that's kind of where I'm a little confused. I thought that the minimum class sizes only came into play if at least one of your classes was being offered a traditional group health plan. If everyone is being offered an ICHRA and you're an employer of 5, then you don't have to meet those minimum class sizes.
Yes, that's correct. I misunderstood what you were asking. Yes, that's true.
Good. So yeah, so because we have a lot of people that are coming to us now, and they're almost onesies, twosies, but they've never had group insurance. This is their opportunity to try it. Another, and this one is sometimes will get into the minimum class size, but the other thing we're seeing a lot is now that we've gone remote, a lot of people are saying, okay, I'm going to keep those in my headquarters on my traditional group plan. We know that that's a robust plan. We know the plans, we know the doctors, we know all of that. And now I've got John Smith in Montana. I don't have that same kind of network. So I'm going to take my remote employees and put them in the, I think it's called the rating area class, where I can give them that opportunity to get the provider that meets their needs. And that's one of the things that I think is really, really exciting. And a piece that I don't think people understand is that there's 11 classes, but like you said, they can be combined, which means I haven't done the math. It's like more math than I want to do, but you have more than 11 classes, because you can have multiple rating areas for the more expensive places to live and the less expensive places, not just to live, but where the premiums are. And you can combine rating areas with one of the other full-time or part-time. And there's a lot of different unique solutions that you can do. And you have to be patient and willing to run all the numbers. But it's been pretty invigorating to see people who haven't previously been able to offer coverage have that flexibility now because of these classes and the age multiplier and even the dependent multiplier, which we haven't spoken about. So I know we said the age multiplier is a 3-to-1. Is there any kind of ratio that you need to stay in with the dependent multiplier?
So I don't believe there's a specific ratio with the dependent multiplier that I'm aware of, but you can break them up in that way. You can say we're going to offer, as long as it's the same for similarly situated individuals. So if you have a specific, reimbursement rate that you give for employee only, then it must be the same for employee and child, employee and spouse, family. So yes, you can differentiate it that way instead of doing the 3-to-1 ratio.
So we've got the complexity of the affordability and all of the compliance pieces that you have to kind of box in. And we have the compliance that you need to be aware of the class sizes. But then you need to notify the employees. So what kind of notices do you need to give to your employees to be compliant?
So there are several types of, generally speaking, employee benefits notices. So this is just another one to have to kind of tack on to that. So specifically related to ICHRA, if an employer is going to offer an ICHRA, there is an ICHRA model notice that was issued by the departments. And so they could use that notice. That notice has to be given, though, if the ICHRA has already been in place. They have to give it 90 days before the start of the new ICHRA plan year. So for example, if they renew their ICHRA in January 1st, then they would have to give it 90 days prior to January 1st, which can be kind of a long time before even open enrollment happens. So that's the way that the rules spell that out. Now, if it's a new ICHRA and the ICHRA is established less than 120 days before the beginning of the first plan year, then the notice for the first plan year can be provided just as soon as possible. That's kind of the standard there.
Right.
We're talking about new hires. You'll need to give an ICHRA notice to any new hires with their enrollment packets, their enrollment materials. So we can't just do it one time. It has to be annually each year. And then again, when we have a new hire that's coming on and is offered the ICHRA.
So annually, I get you do 90 days before the next start year. Does this mean that all new hires must wait 90 days before they can get the benefit?
No, the new hires do not need to be given the ICHRA notice 90 days prior because they may not even work there yet. So that's only for an open enrollment situation.
Got it.
So new hires just need to be given the ICHRA notice in their regular enrollment materials as soon as possible, preferably before the plan or before their coverage begins. So that's the requirement for new hires.
Got it. That makes sense. And then one other quick question, which is kind of in compliance, but you piqued my interest. So we know that an ICHRA is a special enrollment. It's a qualifying life event. You can enroll whenever. And we know that a lot of small groups have their open enrollment periods outside of the ACA open enrollment period. We also know that individual plans change during the open enrollment period, and some plans are in fact discontinued. So if I'm offered an ICHRA and I, let's say, enroll in January, or let's in March, let's make it a true SEP. There's no concern about open enrollment. So I enroll in March, my company is given to me, it's great. But then come November, either my plan is discontinued or I see a plan that's better. Can I re-enroll into a new plan in the middle of my ICHRA year because it's open enrollment for the ACA and keep my ICHRA benefit?
I believe so, because the ICRA is really just a set amount, not necessarily based on the type of coverage I enroll in. The only requirement to be reimbursed for the ICRA is that I'm enrolled in some kind of individual coverage in the first place. So I don't think it's dependent upon what kind of plan, or it dictates, you know, when someone could change the coverage. There's no sort of qualifying event that has to happen there. So I think that's perfectly fine. As long as the exchange allows you to make that change. Yes, I think that's perfectly fine.
Yeah. So what has been some of the biggest compliance challenges or pitfalls that you're hearing from some of your employers?
I think some of the biggest challenges have been understanding affordability, like we mentioned, understanding the class size requirements, although that's not a huge hurdle to overcome, but also just making sure that they understand that they have to substantiate people's enrollment into this individual coverage in order to reimburse the ICHRA in the first place. So that's definitely something that we have to have in place, which is great when you have a vendor like BeW3LL who can help substantiate that there's the coverage there, which then goes on to correct reimbursement. I think also employers have to understand that an ICHRA is considered a self-insured HRA ERISA plan. And so that requires, among just the regular notice that I mentioned before, it requires a summary of benefits and coverage. It requires a summary plan description, SPD, because it is an ERISA plan that is provided by the employer. The ICHRA itself is considered a group health plan. And so just understanding that these requirements are still in play, just as if you were offering a group health plan, as well as COBRA. It is an HRA and an underspent COBRA. An underspent HRA does have to be provided under COBRA. So there's these other additional requirements that they may not be considering and may not do them for a couple years until they realize they have to do this. Also, ACA reporting too. There's specific types of ICHRA codes that have to be indicated on line 14 of the 1095C. So those are just some of the things that I see, little compliance responsibilities that are missed and not communicated.
Right. Right. And it's the employer's responsibility to be sending those out.
Absolutely. Because again, employer sponsored plan, ERISA plan, which means that's their responsibility. It's not the employees. Also think about reporting this on the W-2, kind of subtracting this ICHRA reimbursement from the box 1 taxable income. So it does involve the employer having to do some things. It's not simply just you know, a nice pot of money to give the employees.
Yeah, and definitely we try to help with as much of that as possible. You know, we send out the compliance notice. We've done our best to combine, and there are multiple notices like you mentioned, but we do our best to kind of combine them into one, make it easily digestible for the employee while also meeting the mandates of the compliance requirements. And then giving the brokers and the employers the access to reporting so they can do their 1095Cs or their W-2s or, you know, whatever it is they're doing. We want to make sure that they have access to that information with the click of a button, because it's the whole goal is to make this easier, not make it harder.
Exactly.
That's awesome. Well, thank you so much for joining us today. I think you cleared up a lot, and I know that compliance people get very anxious and nervous, and it seems daunting. I know, Constance, do you have any other questions for Sarah before we let her go?
No, I think the thing I'm really interested in is seeing how ICHRA plays out. I mean, I think year one, it's a huge education process for the employer and the employee, as well as family members, and just kind of seeing the trajectory of ICHRA plans in the market. I think that will be really interesting to see in year 2, 3.
Yeah. Well, Sarah, we'd love to have you back. We always want to learn more about what we should and shouldn't be doing. So hopefully you'll join us for another podcast. We'll reach out to you and find a time. And thank you so much.
Thanks for having me.
Awesome.
Thank you,
Great.
Sarah.
Be well. Bye-bye.
Bye-bye.